Now, several companies issuing profit warnings today, including Pearson Education Group, Imperial Brands, British Airways parent IAG, and Carnival Corporation. Shares of Carnival cruised down sharply on that weak guidance, the company citing weather, policy changes in Cuba, and a ship delivery delay. Carnival Corporation CEO Arnold Donald joins us now in an exclusive interview. Arnold, good afternoon to you. Thanks for joining us.
Wolf, Sarah, good afternoon to both of you.
Let's touch on the guidance first, if we can. Decent quarter looking backwards, I know, but the guidance cut going forward weighing on the shares today. Talk us through the reason for that cut.
Absolutely. As you mentioned, though, we did have a nice beat for the quarter in terms of earnings, but the guidance was we slightly reduced it, driven primarily by the spike in fuel costs. But also we were able to offset quite a few things, including some malaise in Europe in terms of Germany and Italy, continental Europe in terms of economies, but a number of noise things. We had hurricane short-term disruptions in itineraries. We had Arabian Gulf disruption in some planned itineraries. We had to, cancel people, rebook them in shorter periods, and so on. And so a number of noise factors that led us to, primarily because of the spike in fuel prices, to lower guidance a little bit.
I mean, a lot of disruptions, external disruptions, Arnold, between the weather and the Cuba ban last quarter and the oil. I mean, is that really all that's going on? Because your stock has underperformed the rest of the industry.
Yeah, well, I think clearly the noise is there. And, we always have challenges every year. There's always upsets and different things. But this year there's been a plethora of them. And the nature of them, the instantaneous shut off of Cuba and so on. And so we'll see how the other companies do. But just speaking for ourselves, we are still delivering very close to the guidance we gave in June. We're still going to have comparable earnings to last year's record earnings. Still have $5 billion in cash and that we're going to generate. And we still have the strongest balance sheet in the industry.
Arnold, expand a bit on your comments just then about the consumer. Is it just the consumer outlook in Europe that you're worried about, or anywhere else as well, including in the U.S.?
I would say there's clearly some surprises versus early in the year when we first gave guidance with regards to consumer confidence in the U.K. and in Germany. And then there's persistent economic malaise in Southern Europe. All of those things impact us. Again, we have low penetration in all these markets as an industry. We have high guest satisfaction with the product as an industry. We are great value relative to equivalent land-based vacations as an industry. And as a company, we have scale and we have, as I mentioned, the strongest balance sheet. So if we do go into a sustained recession, we're positioned for it. But we did not give guidance yet for 2020. This was just going into the fourth quarter.
So what can you tell us about consumer demand and how much consumers are willing to spend on the ships right now?
What I can tell you is that our onboard revenues are up both in a European segment and in a U.S. segment. So for the year, we'll be up on onboard revenues in both. We've had substantial capacity increase in a number of trades in Alaska, elsewhere. The Caribbean is extremely strong as a market across our brands and for the industry. So there's lots and lots of positives. Even in Germany, our team outperformed the overall travel market and outperformed the rest of cruise in Germany. And we're able to grow earnings despite the fact they had 20% almost capacity increase in a market that was contracting with slowing consumer confidence.
So going back to Sarah's question quickly, Arnold, why have you underperformed your peers so much? Why, if we look at a 12-month chart, is it such a steady trend of decline despite all this upbeat spin you're giving us?
I think the reality is, first of all, from a earnings performance and a performance in the market and with guests and stuff, we're not underperforming, the other companies in the cruise industry. If you look at our return on invested capital overall over time, we're there. But one reason why you'll see maybe a difference in the stock is we are much more heavily invested in Europe. We have as much as 10 times the number of cruise guests ex-U.S. as say an NCL, or 3 times what a Royal would have. And so we're more impacted, by Europe than the other brands would be. But in terms of actual performance, return on invested capital, the real metrics, we're performing very well.
Arnold Donald, thanks for coming in.